Welcome to the deep dive.
Uh,
Okay, everyone, buckle up. We are diving headfirst into what people are calling a high voltage week for global markets.
High voltage is right. A lot going on.
Exactly. And you're about to get a real shortcut to being incredibly well-informed. We're talking at least 8 major central bank and macro releases, all set to, really move the needle. Our mission today, it's simple. Pull out the most important nuggets from this, jam-packed calendar.
So you can understand what's coming, why it matters.
And crucially, what it all means for that big soft landing idea everyone keeps talking about.
That's the core question, really. And look, this isn't just us reading off a list of dates. We're going to unpack the insights, maybe some surprising facts,
Right.
and highlight the events we think are likely to generate the biggest waves, the most volatility.
And you should really pay attention because the most sensitive data, it really hits between July 22nd and July 25th.
And frankly, some of these forecasts, they're pretty eye-popping. We'll get to those.
Okay, so that's the roadmap for this high voltage week. Where do we actually start this deep dive?
Well, I think we have to begin with the central banks, right?
Makes sense. Their commentary is just so crucial for kind of setting the market narrative.
Absolutely. And this Monday, July 22nd, is really interesting. We've got simultaneous speeches.
Simultaneous. Oh.
Yeah, you've got ECB President Lagarde, that's Europe, the Euro, and Fed Chair Powell in the U.S. for the dollar, both speaking on the same day.
Wow. So why is that so important? What are we looking for in those early speeches?
Well, these early week comments, they're crucial because they often give us the first hints, initial signals about how they're seeing the economy, maybe where policy is heading, even before the big official announcements.
Okay.
They can really set the tone for the whole week.
Yeah.
Think of it like a market pregame show.
So it's not just the hard data later,
Yeah.
it's the vibe check early on, like
Yep.
reading between the lines almost.
Precisely. Body language, word choice. They're trying to manage expectations. Any slight shift in tone, maybe more hawkish, more dovish.
They can send ripples through currencies, equities.
It gives us an early read on where their thinking is at.
Got it. And speaking of the formal announcements, we then get to Wednesday, July 24th, the ECB monetary policy statement and the press conference.
Right. And the expectation for the main interest rate decision, that's the big one for borrowing costs in the Eurozone,
Yeah.
is steady, expected at 2.15%.
Okay, steady at 2.15.
Mhm.
And the others? The deposit facility.
Also steady, expected at 2.00%. That's what banks get for parking cash overnight.
Right, a liquidity gauge.
And the marginal lending facility, sort of the emergency funding rate, that's expected at 2.40%. Also steady.
So, okay, everything's steady. What does that actually signal for the Eurozone? And, what extra info does the press conference give us beyond just the rate numbers?
Well, a steady rate usually signals the ECB feels its current policy is appropriate for now.
Like, don't rock the boat.
Exactly. No urgent need to hit the gas or the brakes. It implies a kind of wait-and-see mode. But the press conference, that's where the real juice is. It's not just the numbers. It's Lagarde explaining their thinking, their economic assessment, the inflation outlook, any hints about the future forward guidance.
So you get the why behind the numbers.
Precisely. It lets markets gauge their confidence, their future plans. It's like, reading the press release versus hearing the CEO talk about the company's vision. Much richer context.
Right. The moving picture, not just the snapshot. Fascinating.
Mm.
All right, so central banks are setting that big picture strategy. Let's get down to the real-time pulse, the U.S. economy.
Okay.
Every number we're about to talk about here is like a critical piece of evidence in this whole soft landing debate.
Yep. Is it happening or not? That's the question.
And we're starting with a really important checkup, the U.S. housing market.
Indeed. Housing is like a financial ECG for the whole economy. It tells you so much.
So what are we watching?
On Tuesday, July 23rd, we get U.S. existing home sales. The last number was 4.03 million units. Then Wednesday, July 24th, is a doubleheader. U.S. building permits forecast is 1.39 million, just a hair under the prior 1.394 million.
Almost flat there.
And U.S. new home sales. Forecast there is 651,000, which is actually up a bit from the prior 623,000.
Interesting. So why look at all three? Existing sales, new sales, permits.
Yeah.
What do they tell us together? Is the housing market, basically stable, or are there signs of trouble?
That's a great question. Existing home sales, think of that as the the everyday pulse, activity in the resale market. It shows consumer confidence, affordability.
Can people actually buy?
Right. Are they confident enough? Can they afford the mortgage? New home sales and building permits, though, those are more forward-looking, like a stress test for the future.
How so?
They signal future construction. That means jobs, demand for materials, appliances, furniture, a whole economic chain reaction.
Oh, okay.
So if you see, say, new home sales rising while existing sales are flat, maybe builders are filling a gap, or maybe it points to affordability issues with older homes, it's complex.
But crucial for that soft landing idea.
Absolutely crucial. It hits consumer wealth, spending, validates or challenges the whole narrative.
Okay, shifting gears slightly, but sticking with U.S. employment. Also on July 24th, we get initial jobless claims.
Yep. Forecast is 229,000. That's up just a bit from 221,000 previously.
A small increase. And continuing claims.
Continuing jobless claims, the prior number was 1.956 million. We don't have a forecast here in our notes, but we watch that trend.
Right, so this is really ground zero for the soft landing, isn't it? What are these two telling us about the labor market right now?
They absolutely are ground zero. Initial claims, that's the real-time snapshot of new layoffs. How many people just filed for unemployment this week?
Okay.
Continuing claims, that's the number still getting benefits after that first week. It tells you how quickly people are finding new jobs.
So a slight rise in initial claims, maybe not a disaster.
Not necessarily. It's the trend that counts. And if continuing claims stay pretty stable or even fall, it suggests people are getting rehired relatively fast. That's key.
The Goldilocks scenario.
Exactly. For the soft landing, you want the labor market to cool off gently, not spike unemployment sharply, which would scream recession. It's a delicate balance we're watching.
Okay, makes sense. Now let's look at activity production. On Wednesday the 24th, again, U.S. Services PMI. Forecast is 53.0, just a tiny tick up from 52.9.
Right.
What does a PMI over 50 mean again? And what does this slight rise suggest, given how huge the services sector is?
Yeah, anything over 50 on the PMI indicates expansion. So
Yeah.
53.0 means the services sector, which is like 2/3 of the U.S. economy is still growing.
Okay, still blowing.
The slight increase, 52.9 to 53.0, it's small, yes, but it points to continued resilience, sustained activity.
Good news then.
Well, here's the thing. It can be a bit of a double-edged sword for investors.
How so?
It confirms resilience, supports growth, good, but it might also mean the Fed doesn't feel any pressure to cut interest rates quickly.
Keeping borrowing costs higher for longer.
Potentially.
Yeah.
So it's not just if there's growth, but the pace of that growth that tells a story for policy decisions.
Right. Okay, now, here's the one that really jumped out at me. Thursday, July 25th. U.S. durable goods orders.
Ah, yes. The dramatic one.
Dramatic is the word. The forecast is a massive swing to minus 10.3%. The prior was plus 16.4%. That feels like whiplash.
It is a huge swing. Absolutely. It highlights potential volatility for sure.
And alongside that, we have core durable goods orders. Forecast is 0.0% flat, down from 0.5% prior.
Okay.
So what is going on here? What's the significance of that huge drop in the headline number? And how does the core number help us make sense of it? What does this mean for, future economic activity?
It's a really important distinction. So durable goods orders, that's new orders for stuff meant to last 3 years or more. Cars, machinery, appliances.
Big-ticket items.
Exactly. A sharp drop like minus 10.3%. Yeah, that could signal a major pullback in business investment or consumer spending on those big things. That would be worrying.
Definitely.
However, and this is the crucial bit, core durable goods orders exclude transportation, specifically aircraft orders.
Planes.
Yeah, big, lumpy, infrequent orders for planes can wildly skew that headline number.
I see.
So the core forecast being flat, more 0.0% after a small gain before, it suggests that if you strip out those volatile aircraft orders, the underlying demand for other durable goods might just be stagnant, not collapsing.
So less alarming than the headline suggests.
Potentially, yes. It gives a clearer view of the fundamental trend in business and consumer demand for long-lasting goods. It's like, ignore the one-off private jet sale and see if people are still buying washing machines and factory gear.
Okay, the washing machine index. I like it. Got it. Also on Thursday the 25th, Atlanta Fed GDP Now forecast. Holding steady at 2.4%, same as before. Remind us, what exactly is GDP Now? And what does this steady 2.4% tell us about real-time growth? Is it like an economic crystal ball?
Maybe not a crystal ball, but it's a very valuable real-time measure. GDP now isn't a typical forecast. It's run by the Atlanta Fed.
Okay.
And it's a dynamic estimate. It updates based on incoming economic data as it's released. It's sometimes called nowcasting.
So it changes day by day?
Pretty much, as new data comes in. The fact that it's holding steady right now at 2.4% suggests that based on everything the model has seen so far this quarter,
Yeah.
it's anticipating moderate, sustained growth, a fairly consistent, real-time picture of expansion.
Okay, interesting. So that's a lot on the U.S. Let's look beyond. How's the rest of the world stacking up? We've got services data from the Eurozone and the U.K. too.
Right. Also on Wednesday the 24th, Eurozone services PMI is forecast at 50.6, just up slightly from 50.5.
Still above 50, so expansion, but just barely.
Just barely, yes, more modest than the U.S. Then you have the UK services PMI. That's seen as a more significant indicator, a 3-star event. Forecast is 52.9, up a tick from 52.8.
Okay, so UK closer to the U.S. level. What does this tell us comparing them? Broader global sentiment.
Well, what's interesting is that both the Eurozone and the UK are showing expansion in services, just like the U.S., even if the pace differs.
Right.
The UK's 52.9 suggests fairly solid growth there. The Eurozone's 50.6 is weaker, but still growing. So compared to the U.S. 53.8.
It seems widespread.
Exactly. It suggests the services sector, which is vital everywhere, is showing resilience across these major regions. It points to, relatively positive global economic sentiment, even if it's varied. Growth isn't just a U.S. story.
Good point. Provides a broader base for that soft landing idea globally.
Could do, yeah.
Okay, finally, let's talk about the speculators. What's on their radar?
Mm-hmm.
Thursday, July 25th, we get the CFTC speculative positions.
Ah, the commitment of traders report.
Right. Covering NASDAQ 100, S&P 500, gold, euro, pound, Aussie dollar, crude oil.
Yeah.
Basically all the big markets.
Yep.
So we're getting a peek into what the big money is thinking. Why are these positions important? What do they actually reveal?
They're incredibly important, yeah, because they show how large speculators think hedge funds, big institutional players, how they're positioned in the futures market.
So are they betting up or down?
Exactly. Are they net long, expecting prices to rise?
Yeah.
Or net short, expecting them to fall? It gives you a window into their collective conviction.
Can you give an example?
Sure, like if you see a huge buildup of net long positions in the NASDAQ 100, it signals strong confidence in tech stocks among these big players. Or a big shift in gold positions might tell you something about their views on, say, inflation or risk appetite.
So it predicts the future.
Not exactly predicts, no. But it reveals the prevailing sentiment and potential momentum among a very influential group. It shows where the so-called smart money is placing its bets.
Okay. And that could influence trends.
It certainly can influence short to medium-term trends, absolutely. It's a valuable snapshot.
Right. So let's try and wrap this up, the big picture. This is a seriously packed calendar, no doubt about it.
Absolutely packed.
And it feels like it's really going to test all this recent optimism about global growth and, potential policy easing from central banks.
Mm-hmm. Test is the right word.
The central bank comments early in the week from Lagarde and Cowell, plus those critical U.S. jobs and housing numbers, they feel particularly key, don't they, in shaping whether this soft landing narrative holds water or maybe starts to leak.
Absolutely. It's one of those weeks where, every single data point has the potential to shift the story, sometimes quite dramatically, like we saw with that durable goods forecast.
Yeah, indeed. So maybe a final thought for everyone listening. Given this wide range of data, especially that eye-popping durable goods forecast,
Yeah.
how might all these pieces together influence your view on global economic resilience over the next few months?
That's the key question to ponder.
And maybe, as you see the headlines fly by this week, what specific number will you be watching most closely? Which one will challenge or confirm that soft landing idea for you? Something to think about, isn't it?